Hey guys, today on the podcast we have Mr. Mark Ainley, I always screw up his name, with GC Realty and Development. If you want to know Chicago, when we talk about real estate, this is a guy that you want to know. You talk about property management, you talk about the BRRRR strategy, this is it. So welcome Mark to the studio.
Thank you for having me.
Definitely. So Mark, let's jump right into it, right? I mean, there's a lot, you happen to kind of live in my old neighborhood, right?
Yep.
We were neighbors, and I didn't know you for the longest time until we were on a panel together. But let's kind of, you're a Chicago guy, right? Did you grow up in Chicago, or how did that start?
I grew up right up the street here in Addison, so
Okay.
I've been a DuPage County person my whole life. I've moved around. I live out in St. Charles now, but I've really dove into investing in Chicago in the last 10 years. So what I didn't know prior to 10 years ago, early in my real estate career, I got my real estate license in 2003. So we're an 18-year-old startup now at this point.
Okay, got it. So let's kind of start from there, right? You get into real estate 2003. You do, at that time, did you start with retail sales? Did you jump in with investors? What was kind of the start like?
So I started, it's a funny story because I started with my first place that I bought. And I did what they would call, what was the definition of a house hack to me then. It was buy a house and let your friends crash on the couch or the extra bedroom. So that was a true house hack back then, definition. So I saw that, and just having, I was 21, I was the first one out of my friends to get their own place. So having that, I'd have friends crash in there, $400 or $500. I was actually making money, or at least covering my groceries even.
So the old school BRRRR strategy, basically, right?
Yeah.
Right? So basically, you buy that property, and then you rent it out to your friends, kind of, they're staying there, and then you're renting out rooms, basically,
Yes,
right?
yes.
So instead of renting from somebody else, it's yours.
Yes.
And then what was your start in real estate? Like when you officially got your license, started actually being a real estate broker as we know it today?
So it wasn't long after I bought my first place and started renting out to my friends that I realized I'm like, I like real estate. Growing up, I thought it was the stock market or Wall Street because Hollywood makes it look glamorous.
Sure.
And so I shifted my mindset to real estate after I bought my first place. And after I bought my first place, it wasn't maybe 8 or 9 months. I was sitting on the couch with my buddy at a condo in Rolling Meadows, and we were playing Madden. So we're still pretty young. I think I was on my lunch break for college. And under the door they slid, the apartment complex said, we're going to be converting this to condos. If you buy this today, we will sell it to you for $10,000 less than when we offer it to the public.
Got it.
Now my W-2 mindset at that time, because I was still working and going to school, said, wow, I only made $40,000 last year. That's 25% equity I'll have, not taking into account all the things that I know now of closing costs and all those things. If I had to sell it, I'd have to pay 3,000 commissions, all that stuff. So, but in my mind, I'm like, wow, this is great. So I ended up buying that property. So that was my
And where
first
was
purchase.
the property that way? At least the local people will
No,
understand.
it was in Rolling Meadows, so not far. I was living in Schaumburg at the time. My first place was in Schaumburg. It was a townhouse there, and my second place was a condo in Rolling Meadows.
Rolling Meadows, okay. So you get started with a condo conversion, right?
Yes.
And then what happened next? I mean, what was your kind of intro into real estate sales?
So the day I closed on my place in Rolling Meadows, I came home, I was all excited, and my best friend who I started GC with was there at my condo, and he said, Mark, I've been telling you, he was preaching to me, get your real estate license. He was working for another commercial broker down the street, and he did on the calculator, we weren't using the phones back then, calculator, so he did on the calculator the amount of commission I would have gotten for that. Turned around to me, and it was like $3,300. Now, in that split second, I realized that's carpet, that's 2 months carry costs, that's paint,
Sure.
and I'm good to go.
Right.
And right there, I realized I don't have that money. I was mad. I signed up for the online course that afternoon.
Okay.
So that's how I got my real estate license.
Got it. So you get into real estate, and then did you go to retail sales like everybody else, or did you jump in with investors at that time?
So I jumped in with investors, and a lot of that was based on that condo that I bought and my horrible experience. Now, the horrible experience was totally self-created because I put the ad in the Herald, took the first sad story, which I thought at the time I was helping somebody.
Helping somebody, of course.
And I ended up finding myself for the next 3-4 months literally driving from Schaumburg to Rolling Meadows every couple of days to pick up $18, $25, $72 to get rent. And I filed for an actual eviction, and I did ultimately the modern day cash for keys with that unit. And I said at that point, I am never managing a property again.
So today, I mean, having said that, right, and I should have said that right in the intro, you manage over 1,200 units.
Yes,
today,
we
right?
manage over 1,200 units.
Obviously, you're not feeling bad for people. You run a business today, right? because a lot of people do this, and we have all gone through it. We feel bad. You hear a sad story. Talk to me from an investment perspective, right? Because management happens to be one of those places. You can buy the place right. You can do everything right. You can fix it right. You can put the right loan on it. But yet, that's one place. If you screw that up, you're done. I mean, your goose is cooked. And it's going to be a very painful experience. And a lot of people don't come back to real estate because they're like, I had a condo. I lived in it. Everything was great. I rented it out. Man, that tenant. And I sold it. I'm never buying real estate again. You've probably heard that a few times.
Yes.
So explain, what exactly do you do today?
So, like you said, we manage 1,200 properties. We focus more on the scattered site, 1 to 4 units. We have a 56-unit complex we manage in Geneva, but we focus on the smaller stuff or investors that own multiple scattered properties. And I always tell people this: when you manage a property, you're managing, yes, the actual physical property, whether it be making sure for a multi that the snow is getting shoveled or the grass getting cut or you're doing your annual maintenance, but a lot of it is management of personalities. Now, those personalities might be the tenant, might be the tenant's occupant that's not supposed to be living there, might be the neighbors trying to communicate with each other. Usually it's in a negative way. It might be the village, if you have a rental license that you have to follow and making sure that you're managing their expectations. And it's just managing a lot of personalities and trying to do the right thing. And always, I don't know if the right thing is, I always have the upper hand and control over the situation.
Got it. So, I mean, that starts with like tenant selection, the process of approval, that kind of stuff. But I want to kind of go back, right? 2003, we all know what happened in 2008, 9, 10, 11, 12. Did your business change at that time? Did you see, clearly there were people taking a beating. What was your business like at that time?
So we were very flexible back then. When we first got into the business, and it ended up changing around 2013, but when we first got into business, we just went wherever the money was at. And I think like most entrepreneurs, you might have a business plan, but then things shift, and you're kind of, at certain points, every entrepreneur will go through the survival mode.
Right.
Like, I just got to make money to get through next month. So we went through a handful of those. And when the market collapsed, we ended up shifting into some property preservation. I was getting into leasing heavier, and then our management just started to grow. But that's where we jumped back into buying properties. And I'll tell you this, getting your license in 2003, understanding what cash flow is was not really something that we knew before the crash.
Okay, so explain that. This is, there was a Rosario, right?
Yes.
So there was I thought it would be an interesting recording. It came out great. I called it the broke broker, right? Because my belief is that as real estate agents, we can make a ton of money, right? And some people do make a ton of money. But yet, as a group of professionals, we're broke, right? I mean, I hate to say this, and there are a lot of people that I remember 2005, 6, making $1 million gross commission earned, right? And 2010, 2008 or 9, they had nothing. Nothing as in like nothing. They went from driving an S500 to literally waiting tables, right? And why is that? Does that happen in our industry? We're supposed to be in the real estate business, right? But besides doing sales, for some reason, we don't understand the business of real estate.
Yeah, I wrote an article recently, put on Bigger Pockets, but it's all about the investment-minded real estate agent. And when I started researching that and really trying to understand what numbers I'm putting out there, there's such a small percentage that actually are investment-minded. You always have your mom's realtor that sold your neighbor's house and all that, but they don't understand everything that you stand for, everything that I preach for on our podcast.
But why is that? Because, they're good people. There's so many people that I know, right, that are really good agents. They work their butt off trying to do the right thing for their clients. And they're like, oh, Andrew, I know how that works. That worked out for you, but I really don't want it. It's a lot of headache. And I'm like, guys, we're in the business, right? It's like if you work at a Mercedes dealership, drive a used one, man. If you can't get a new one, it's okay. But at least stand for the product that you sell, right? Yet you can't drive a Honda or Toyota because you don't even believe in the product that you're selling. And a lot of times I think what it is we're taught, quote unquote, real estate sales, retail sales, but nobody ever says, hey, listen, part of this is that we don't have a 401k, we don't have anything, right? That we need to start building that. And this has always bothered me, so I know it's off topic, but you're one of those guys that would understand what I'm coming from.
There's always the good intention. So no different. And I have a drip campaign that goes out to realtors about property management. I try to educate them on a lot of what we're trying to educate people on, and a lot of it comes back like, oh yeah, I can't wait to start buying properties in the next couple of years. It's like, start now. So a lot of it is wishful thinking, I think a lot of them. And then the other part of it is just fear of the unknown. I think a lot of realtors are no different than a lot of real estate investors that have nothing to do with the industry. They just want to be investors but are scared to pull the trigger.
And the other thing that I found with a lot of people, professionals, right? Agents, loan officers, people who are in the title business, we're so close to the business. Sometimes I think we're in the picture and we can't see the frame.
Yes.
Right? Because we know everything there is to know. We're not ever open about ideas. And I'm not putting agents down, mind you. I mean, I still have my license. I intend to keep it. And I have a lot of respect for agents because I know what it takes, right? to sell a house. I mean, how much it looks very glorified from the outside, but it's a pain in the butt business, right? And a lot of times I think we're basically experts at chasing our tail.
Yep. Yeah, no, 50% of everything realtors do, you never get paid for.
Yeah, no kidding. I'm going to say 80%, man. So let me kind of pull back, right? So 2008, 9, 10, 11, at that time, you were doing property preservation. Did you start like working with investors kind of one-on-one at that time also? Did you see that coming?
Well, one of the things I did before the market crash and how I kind of cut my teeth was I was able to, because we were selling a lot of investment properties back then. Now, investment properties in 2007 was a lot different than what you might in 2015. Now, investment property then was, hey, here's a good property in a good neighborhood. If you hold on to it for 6 months, you'll make 30 grand and it will sell it right away. And I'll make, and a lot of people, I made a lot of people a lot of money and they referred me a lot of people. I made a lot of those people a lot of money. So, but along the way, you had the similar concept of the flips. Burr holding it didn't make sense back then. But what we did a lot of back then was we had 3 or 4 clients that we would find the property as realtor, fix it for them as a contractor, and then sell it for them as a realtor. Basically, we were a turnkey flipping operation, and that's how we learned everything to really take into post Great Recession.
Got it. So let's talk about Chicago, right? Because that's kind of your bread and butter, right? Do you do any management outside of Chicago, or it's all Chicago-based?
We're all Chicago and suburb-based for the most part.
Chicago and suburbs-based. Okay. So I always feel that Chicago has been one of the best markets in terms of rentals, if you truly want to own rentals, but it's a tough market, meaning there's a lot of BS you have to deal with here that you don't have to deal with the rest of the country, right? You want to kind of get into that a little bit because we have, some of it is neighborhood-based, right? A lot of people tried to come into Chicago, some of the C or D neighborhoods, and I mean, they got killed. I'm not talking about literally killed, but they got killed financially, right? Why is that? And we know you can make a huge return there, but yet those are tough neighborhoods to operate in. Yet you can do it very successfully. Any comments on that?
So let me tell you something. When we started buying properties on the south side of Chicago in 08, and we did, between 08 and 18, we bought and rehabbed 482 units. Now, we went down there in 2008 with the intention of outsourcing management.
Oh, okay.
Just because we didn't know what we didn't know. Now, we went down there, and we were already managing our nice class A and B out in Hoffman, Elk Grove, and all that. So we said, you know what, we'll lean on somebody that's an expert. Now, we couldn't find anybody that we thought was the expert. Just the feeling you get or the interviews you have, just the confidence level wasn't there. So there's a handful I know now as well in addition to us. But we ended up starting managing our own stuff one at a time. Now, between 08 and 15, all we did is manage our own stuff. Now, we didn't know what we didn't know, and we cut our teeth on it, and we made a lot of mistakes on our own dollar, and we didn't understand how intense C&D management is. Now, C&D management, it has to be like a 6-to-1, like if not more, touch point when it comes to daily management. I have tenants in Naperville that have been there for a decade plus and might have had 2 or 3 work orders. I have tenants last week in the south side of Chicago that we've had 2 or 3 work orders.
Right.
So it's a whole nother level of things. Now, let me answer more on the, Chicago has a very unique situation where we have different specifics about neighborhoods that you need to know locally. We have a whole bunch of different laws, and more coming into Cook County here in 2021. We have all these different ordinances, and then you break it down. Now you got Section 8 is different in so many different ways. CHA, Chicago Housing Authority, Section 8 is different than any other housing provider in any other housing that does Section 8 in Chicago. And now then you put on in the suburbs all these different rental licenses. Getting a rental license in some of the south suburbs, I mean, that's a 10
It's a
hour,
nightmare.
That's a nightmare in itself.
It's a nightmare.
Now you take all these things. Now what that does, that keeps a lot of investors or fund money or Wall Street money back out of Chicago because they don't want to mess with it because they can't put a process together to narrow it down enough to be successful. So that leaves it open for what I would call a lot more smaller players or mom and pop type investors to really take advantage because there's not the big financial backing.
You know, he said something very, very key there because a lot of, and that's what I've felt, that Chicago is such a unique market, right? That you can't sit in New York. And the more money you have, the more money you're going to lose, right? The hedge funds tried it here. Oh, we have $50 million, we're going to dump it next 60 days. We're going to buy the property. You could buy the properties. You can buy the properties at pennies on a dollar one time. The problem was, how do you manage the sucker, right? Because if you have the property in Wheaton versus Glen Ellen versus, say, Southside, right, there is no format of how do you deal with the inspectors. There's no uniformity anywhere, right? So the process is very, very labor intensive, and you have to really understand how to work with each different suburb, each different township, because that's complete, and which is very unusual. You go to Florida, pretty much it's all the same. Texas is pretty, there's no uniformity in our market, and that gives us a strategic advantage, right? Yes. As a small investor, you can literally sharpshoot. You can sit at home and then boom, 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 pick off properties, but you have to understand those suburbs, yes. Right? So investing, a lot of times people have made this mistake. I just had a call the other day, somebody who owns a bunch of properties, Waukegan, right? He's like, man, it's kind of getting tough. I'm just thinking about going to Southside. I'm like, buddy, you live in the North Shore, right? Far up suburbs of the North Shore. How exactly are you going to manage it? Oh, I'm just going to sub it out. I'm like, good luck. Actually, I gave him your number the other day since I'd been on your podcast, right? And I'm like, you might want to maybe talk to somebody who knows what they're doing. But why is Southside so different?
So I was explaining to someone this morning actually on the phone. So the thing you have about the South Side, and this is I'm speaking very general. There's a lot of good neighborhoods, good pockets, good corners, and those are that's another thing about having the unique. Like to understand, maybe just take a community of Woodlawn. There's certain areas that you stay away from, right, and other areas that are awesome. And now maybe the areas you're going to that I say stay away from, maybe that's the wrong thing, but you're going to pay a heck of a lot less than 6 blocks over. Right. So understand those things. But the South Side, as far as a lot of, you have your 25 by 125 standard lot. You could control everything and make everything perfect, but then it's the external, how it was the real estate definition, external obsolescence that are external functions that happen that you can't control. I was telling somebody, you can't control the neighbors, you can't control the house that burns down across the street and sits empty for 2 years. You can't control the car that crashes through the gate on the corner on your beautiful new wrought iron fence. It's happened to me. That's why I say that. It's happened to me twice in one time. I put a beautiful $2,700 wrought iron fence. Car crashes through it. I filed an insurance claim, put it back up, and 6 weeks later, a police car slammed through it.
No, what people don't understand is, like, with a place like Chicago, maybe New York is that way, I don't know. But with Chicago, especially if you live in the suburbs, right? My business was always in Schaumburg and kind of outer suburbs, kind of northwest and western suburbs. And I really had never been to Southside. I had never been to Southside until sometime around 2010 or 11. I go to Chatham. I had no idea. Might as well be, another country. And I show up there, and I'm looking at houses. I see a Frank Montrose sign, a property for, I'll never forget this, $215. Right next to it, you could buy a house, $25,000. Right, it's boarded up. And I'm going like, man, this guy must be crazy. How is he going to sell the property? 2 doors down, Frank Montrose sold. Frank Montrose sold. Frank Montrose sold. I'm like, who the heck is this guy, Frank Montrose? At that time, I had no idea. And then I'm like, clearly, this guy's selling a lot of properties in that particular section. And I started realizing it's very unique. You can have a boarded up house, which, you would never go into. Yet next to it, people will buy a property that inside is done better in terms of fixtures, in terms of how it's done, than in South Barrington. Yep. Right? It's a very unique market, which is very tough to understand if you don't understand kind of the unique things about that particular market. And you could buy a property 2 blocks over, and it is a phenomenal neighborhood in the same pocket. And you'd be 2 blocks over, and you're like, you never want to go there, doesn't matter day or night, right? And which is kind of unique, and people a lot of times are shocked, because you're like, oh my God, this is a beautiful neighborhood. Parts of Chatham, at the time I went there, it's better, cleaner than Berwyn.
Yes.
Neighbor will come up, hey, why are you sitting outside my house? Right? I mean, it's people are that concerned. And when you have nosy neighbors, I've always felt, I love those neighbors.
That's the best.
Right? Because they care about the property, yet you go 4 blocks down, I mean, it's a war zone, right? And that makes a big difference, which makes, I think, Chicago really, really unique. And I mean, both of us have a real estate license, so we got to be careful but you have to look at what your investment is. What a particular pocket, you just can't say, oh, that's a good pocket, that's a bad pocket, because it depends which block, which street, what. Are there multifamilies on that street? Are there single family properties? Are even in single families, are there brick versus frame, right? Which is very unique about Chicago.
Built before 1920 or after 1920, like there's all those little copper versus lead. Like
copper versus lead.
That's the number one thing I find myself preaching on. Like, yeah, it's a great deal, but you still have 120-year-old pipes in there.
So what do you say to people? Let's just say people want to come into the Chicago market, right? I want to mention you have a podcast. We want to mention that, again, it's called Chicago Investor Podcast. And guys, one thing, that if you want to invest in the Chicago market, if you're currently here, or if you're listening to this and you're from somewhere else and you're interested in the Chicago market, this is a podcast that these guys do. It is phenomenal. It is really, really, really great podcast. We put together,
we originally came up with the idea to do for Chicago, the 77 communities, do one for each. But I said, you know what? There's too much meat on the bone when you get into Elgin, Joliet, out there in the suburbs. So we started up Straight Up Chicago Investor just about a year ago. And you're going to be our 50th episode that rolls out here in a couple weeks. But our goal was to just have a street level education for people. Because there's a lot of that, like you're saying. You could be 2 blocks north of 79th Street and sell for 200, 2 blocks south and never be able to sell it.
Correct.
So there's all those little things. And our goal is always to get really on the street level. And then at the same time interview people like yourself that know so much and has resources. It's Chicago. It's all about I got a guy, right?
Right. No. I mean, it's great because it's like I think there was that you fill such a great niche in the marketplace when it comes to podcasts, because there's a million podcasts on real estate, right? But it's Chicago specific. I mean, it's 9 million people, for God's sake, right? So you have a massive audience and people who come and invest in Chicago, right? That are from out of town. So for somebody that may be local, or for somebody that maybe is from out of town, right? Besides calling you, what should they start looking at in today's business environment? We're recording this, obviously, February of 2021, right? So we're still dealing with the whole Corona thing. We're hopefully working our way out of it, but where do they start?
So anyone out of state, I always encourage them to find the right property manager, and whether it be in this market or Dallas or whatever, I think a lot of that, when you're out of state, having the right person to lead you with that, or be a second set of eyes to whoever the broker you're going to work with is important. But, I think in today's environment right now, it's just understanding what deals look like. I think you preach to your group a lot about being able to find a deal and pull the trigger right away.
Right.
And I think I see a lot of out-of-state people that they don't pull the trigger on a lot of the awesome deals, and then all of a sudden they get upset themselves for not pulling the trigger on the right one, where then they buy a not as nice one.
Right. You're big, active on Bigger Pockets, right? A phenomenal resource. And a lot of times people will ask a question. The other day, I think I answered one, you answered the one on that one. And they say, what is the A, B, C neighborhood and D neighborhood in Chicago, right? It's a great question by itself. The problem is, it's like you put 50 cities together, right? That's what Chicago is. How do you can't even start to really answer that. And a lot of times what I see happening is people understand kind of a overall picture and they think they can be a great investor. You really have to understand it on a very micro level, street by street. And that's why having the right contact, having the right person, somebody who's experienced, becomes so important. Would you?
I agree 100%, because you have a lot of the selling community out there putting stuff that, we're talking about how sensitive a couple blocks might be, but you have a lot of people in Inglewood marketing the properties close to Obama Library, when that is like 7 worlds away.
Right.
So there's a lot of understanding what's really what and what in the, a lot of us real estate investors, we buy based on what's going to happen to a certain area. And it's important to really understand what's going on in that very localized little corner. The whole A B C D thing is very, that's exaggerated depending on who's telling you it.
Right. No, and again, the definition of A, B, C, and D, it changes.
Yes.
Right? I mean, what I would call a B or a C in the suburb, and I didn't understand this. I mean, for the longest time, in fact, I missed millions and millions and millions of dollars of opportunity in Chicago, city of Chicago, because I was scared. Right, I didn't understand the neighborhoods and how they changed. Some of the Little Italy and all that area. Oh my God, I should have picked up properties like no tomorrow because I mean they've just gone through the roof.
Yep.
And that area was very, very strong. Obviously, when the downturn came, I did not pick up on that. I was like, oh my God, there's so much in the suburbs. But yet, if you really understood that market, there were some phenomenal opportunities that were there and even that are there today. Right, in the growth of, in kind of the progress, kind of the way growth is happening of Chicago, and some of the areas, some of the pockets of Chicago that I was like, oh my God, never going there. I mean, those are some of the hottest flipping markets today, and at some point they will flip, right? But you got to understand that literally street by street.
Yeah. Well, one of the things that why we focused on the city so heavily was because the taxes are so much cheaper.
Yeah.
I'm almost kicking myself in the reverse concept, but we passed up on a lot of deals in Hoffman, Elgin, all that stuff when we were chasing after the $1,200 or $1,300 a year tax bill, which we knew. Everyone hears about taxes in Illinois, so for us it was always all right. If taxes went up 20% like they're supposed to, or have been said to be, 20% on 1,500 is not as bad as 20% on 7,000.
It's always interesting whenever somebody says, Andrew, Chicago taxes are going up. I'm like, dude, you're not even paying $2,000.
Yeah,
what's the big deal, right?
Yeah.
I mean, really, what is the hit you're taking? $50?
Yeah.
I mean, they're going to go up by what, $200?
Yep.
Right? Big deal. It's not going to, I mean, if you have the property rented right, if you bought it right, it should not make any difference, quite honestly.
Correct.
But it's for people in Chicago, whereas literally you could go from Chicago right over to South Holland. Boom, right? $130,000 property, $140,000 property, you're going to pay $5 or $6 in taxes. It's just a fact of life, right? Which is shocking to people unless you're from Jersey or New York, right? It's shocking. Those numbers are huge in our market, and that makes a big difference. So let's talk about kind of what you see today, right? We obviously have some interesting ordinances in place for Chicago. I mean, there is no way if you're from out of the Chicago market to avoid them. Right? It is, you better equip yourself to deal with those, and that's it, period. Right? You're not going to beat those, and you're not going to outsmart them. But what do you see today? Because still the moratorium is in place, not only Chicago, around the country. How are you dealing with that in terms of management? Because that, I'm sure, once this Corona thing hit, it created another unique challenge.
So for us, under our portfolio, the actual people that were truly affected by COVID, maybe they lost job, reduced hours, maybe they actually got sick, they had issues paying, and they were not a problem. It was the select few or the small percentage of tenants that said, screw you, we're not paying, we don't have to.
Right.
Now that was the adoption that we had to make.
The abuse of the system.
Yes,
rather
the abuse
than
of the system. Right. And hopefully here in the next couple months, it'll transition at least baby steps to the people that really can't prove it or are cheating the system to really take advantage of that. Now, a lot of what we've been doing is, it used to be a benefit when you bought a property that was occupied.
Right.
Now I've been encouraging people that are buying occupied properties, make them prove you that they've been paying rent, and not just like a letter from the seller, because we've had buyers that have closed on a 3 or 4 flat, and then we find out that the 3 or 4 tenants have not been paying, and we took their word for it, and going, you know how it is, going after somebody after closing, it's not worth your time. So getting true paper trails of payments for that is, or simply just having units vacant and controlling your own destiny by your own screening standards and screening is where I think a lot of people go. But as far as adjusting going forward, I don't know if this is a question you're asking, but I think there's a lot of opportunity in the upcoming year as far as properties. And I don't think it's going to be the REO properties yet, because
that's going to take time.
Yeah, I know. I was just talking to our mutual friend, the REO from Remax, and he, his pipeline's deep. He's going to do a lot of preservation for the next few years.
Yeah.
But but the people that are going to eventually be filing for eviction, or the people that, this is their one property, maybe they bought it and their wife never agreed with it, and now they just need to get out for whatever they have into it. That's where you're going to find some good opportunities here in the next year.
Yeah. I mean, basically people who are just sick and tired.
Yes.
Right?
I think when you're an investor, an entrepreneur in general, there's a level of risk tolerance and you're okay with a level of discomfort. A lot of people jump in this business and they don't have that tolerance for it. Yeah. Even when they hire a property manager, they can't even handle it. The property manager's telling them certain things. So those are going to be the first people that are, I'm already seeing it happen. Those are the people that are exiting out, just trying to get out for not having to bring money to the table and walk away. So that's where I think a lot of people have opportunity here in the next year.
No, I think I agree with you 100% because those people are going to bail, right? And for smart investors, it's not going to be, I think it's going to take time because all the stuff is going to get cleared out over a period of time, right? And there's a lot of money on the street. I mean, we're already seeing that a lot of investors have money and people have realized you can do really well as long as you buy smart. So it's going to be, this time I think it's going to be more tactical than last time. And last time you could eeny, meeny, miny, mo.
You just had to find the money. You just had to find the money.
Yeah,
That's
you
all
just had
to,
to, exactly, because that time money was scarce. This time people have the money. So you really have to be smart and do your homework when you're buying. But I want to go back to that question, which I was trying to really get to, that with the portfolio you're managing, right? You're managing some areas that are we would call C&Ds, right? In that, did you really see a spike in non-pays or people who were kind of trying to shrug their responsibilities, or has it been overall pretty decent?
Where we ran into the hiccups was in August. We actually did really good through August because we started tracking right when COVID hit in April. Our 12 months, our collections versus our 12-month average.
Got it.
And where we ran into issues was in August when the state came out with the $5,000 grant. Now, one of the provisions of that grant was to be behind in rent.
Right.
And all of a sudden, we had all these tenants like, hey, listen, I'll pay you.
Yeah.
Now, at the time when that came out in August, everything was supposed to be announced in September.
Correct.
We actually got, today's February, and we actually got one of those $5,000 checks today. So we had the program went a lot longer, and all of a sudden we had 40 or 50 tenants that were now behind August, September, October, November, when this was supposed to be wrapped up in September and they'd be a month behind. So that's where we're cleaning up a lot of our actual messes. Now we had those, and we had a few pre-COVID people that were actually on their way out that just basically buckled in, threw down the shades, and we've thrown every money at them, and we can't get them to budge. So those have been our two problems. Now there's gonna be another level of grants coming out here in the upcoming weeks that we're keeping a close eye on. I'm sure you guys are too. That will hopefully clean up some of those problems. But a lot of the people that are actual problems, it ends up breaking down to relationships. You have to get on them almost to a point where it's like, hey, listen, man, this is going nowhere. You're hurting us. You're going to hurt yourself eventually. Let's work something out here. Here's some money, and move on, and give me my vacant unit left to figure out what I got to do next. So.
Because I mean that was one concern that we had, right? I mean, even with the group of Mastery people, they have close to about 11,000 properties, right? And this was the first thing that kind of, as soon as the shutdown came, and I'm like, I wonder what the numbers are. And so I told everybody, guys, across the board, think about 15%, right? Maybe what if you don't collect 15% of your total rents? So if you have 15 properties, maybe you're not going to collect basically 15% of that, 20% of that. So operate with those margins. Start calling the banks today, even before there is a problem, right? Fortunately, we've had about 98% collections, right? So the numbers have been a lot better than what we expected. Now, we're kind of skewed a little bit because most of the inventory is going to be towards the suburbs, right? So it's going to be a little bit more skewed, and most people have 2 or 3 year leases, right, rather than a year lease. So let me talk about a little bit about, I guess, Chicago housing. What is that called? Chicago Housing Choice Program, Section 8,
yes.
Right? The generic name would be Section 8. Do you guys have a lot of those? You have to in Cook County, right?
Yes, so we have, so in Cook County, you can't discriminate against it, but a lot of times the numbers don't work out. So that is your...
Based on the rent.
Based on the rent, yeah,
right.
So it doesn't make sense. But we have, I think we have about 175 Section 8 tenants, and I think 125 of them are CHA, the balance are HACC. But yeah, so it's important balance, I think. And so when we got into buying properties back in 2008-9, that was great. There wasn't as many, unemployment was at a crazy, probably highest I've ever seen in my lifetime. And it was just a way to offset your risk. And we've fallen back into that in the last 12 months as far as making sure if we have a choice, opportunity to have a Section 8 tenant, we take it.
Got it. And with Section 8, what's interesting is this, that a lot of times, people will either have a negative connotation or a positive connotation. And a lot of it is, and I initially, to be very quite honest, didn't have a very positive connotation of it because I really didn't know what the paperwork was. Right? I didn't understand what it was. And as we started buying properties more and more, some of the tenants that we have had, right, are still with us. And these were properties we bought in 2011, literally, right? And they're some of the best tenants I've had. Now, we have had people who abuse the system also, right, like anything else. But you get a mixed bag. But you have to do proper screening. Would that be, because that's the next thing I want to talk about is because in terms of management, that's probably one of the biggest things you guys focus on.
You know, I tell people that call me up and start talking to me about management and what we do is, if we could get the screening part right, meaning put the good tenant in there, that sets the course for the rest of our relationship. And we screw that up, you're going to lose trust in us, you're going to fire us, and you're definitely not going to refer us. So we put a lot of effort and emphasis on really trying to find the right people up front, which, you know, we've talked in the past about setting the right price and so forth.
You know, it's kind of interesting now looking back at it. 2010, I started buying rentals, right? And at the time, I didn't do any screening. It was my own screening. I would show them the unit, and they're like, well, we like the unit. I'm like, great, go to the office, pick up application. And the first time I did it, it wasn't done on purpose. I really forgot to bring an application with me. And I remember the lady had a fit. I mean, she just had a fit. She's like, what do you mean you don't have an application? I'm like, ma'am, listen, I own the property. I genuinely forgot. I apologize to you that I genuinely forgot. But I'm like, if you're this rude now, clearly you don't want me as a landlord because I have more money than you. And I will drive you nuts because we follow the rules and we're going to make you stick to the rules. What I realized was a lot of times, the first 28 tenants I remember, I did not do any screening. I'm not suggesting that you do this, right? But I would make them jump through, and everybody had to jump through the same hoops, right? But I would go show them the property. If they didn't show up on time, I would leave. If they weren't organized with all their paperwork that I'd asked them to bring, I would leave, right? I had all these hoops that I would put everybody through. All the people who would make it through those hoops, they were the nicest people. We never had a single eviction because they were rented based on who they were as human beings, on their character, not on what it said on their credit report, right? And I truly believe that a lot of times it's, if you do proper good screening and put everybody through a specific set of guidelines and don't basically feel bad for them because oh, I have to have it tomorrow. Well, why? Because I'm living at a hotel, right? Yeah. I'm sure you've had those, right? That's a big red flag. Yeah. Do not rent to them. Do not feel bad. This is a business, right? You really feel bad for them, give them a check for $1,000. Say, hey, trust me, you'll be better off.
It'll be cheaper.
It'll be cheaper. But in terms of, so obviously with the amount of units you guys manage, right, you have a pretty specific process that you go through.
Yes, we do. So we have a specific process, and we put together, so up until 2013, I was underwriting everybody. I was so scared of putting somebody bad into our places, because I know that first property I ever rented out, I messed up myself, and that feeling I felt, I never wanted our staff to feel that. I never wanted our owners to feel that, and I've always taken everything that happens to our clients very personal. So we put in 2013 in order for me to get out from under it, and then we're working it. So I think when you're working at A/B, I think screening is a lot clearer. Either they have six-figure income and 800 credit score, or they don't. But when you get into C and D class neighborhoods, it's a lot more gray. And we put together this matrix where we took all the data we had from the previous 8-9 years, and there's tenants that when they had this problem or this issue or this deficiency in their application, they weren't a problem. When they had this one, they weren't a problem. But when they had both, there was a really good chance they weren't going to pay, or they're going to be late consistently paying, or they're going to be a pain in the butt about maintenance and so forth. So we put together this matrix to really screen all of our tenants to acceptable, high risk, and denial status.
Right.
And that was a very valuable tool that really helped us get to this point. Now we shifted those standards a little to reduce risk last year. We lowered our thresholds for each one of the three options. But I think that's important. And one other thing about the applicants and the screening, I think your product too. One thing I realized if you take cut corners on your rehab and it's noticeable, I think you attract less of a quality tenant too. And then get in some of the rougher neighborhoods, it's tougher to attract better tenants because they might know that's a rougher neighborhood. So,
right.
Screening is important.
wouldn't you say that it also depends on what time of the year you rent? Because I always feel that during the winter time in Chicago, right, generally, number one, it's harder to find good tenants. Number two, that people who are moving at that time are poor planners, and they don't necessarily make for, and I'm not saying everybody, but there are certain telltale signs, right, that it's a character thing. To me, it always goes back that we've had some tenants that truly, if they're behind, they truly feel bad, right? They'll call you, say, hey, listen, I'm going to pay you, blah, blah, and they literally make an effort. Now, if somebody just loses their darn job, something happens, what do? Right? It's not those, it's the people who are the bums, right? Who just want to abuse the system is where I have the problem.
Agreed.
Right? So you kind of said something about the suburbs versus, some of the C and D areas maybe in the city. But there's a difference even between the Hoffman Estates of the world or the western part, northwest part of the Chicago suburbs versus if you go to the south suburbs, right? Both places are suburbs, yet on the northwest side, you're going to have more white-collar workers than in the comparatively than in south suburbs, right? It's going to be more blue-collar workers, right? Percentage-wise,
yep.
Right? And there is a difference in terms of income-wise,
yep.
And so you have to have standards. And we're saying this, and I want to point this out to people, that it's important, guys, especially if you're going to do this professionally, that you have a set guideline of standards and you follow those, right? It is more important than ever that you have that specifically, because one of these days, trust me, somebody's going to say, oh, you were unfair, right? Oh, you did this because I was such and such, right? It's going to happen. And if you predictably fall back on, hey, these are our set of guidelines and this is what we do every single time, right? You will never have any issues. So that makes me think about like the new ordinance that just came in, right? This is something that I know you were kind of talking about this even before I was aware of it, right? To part of it, I've been kind of a little bit immune because we really don't have any properties in Chicago, city of Chicago, right? So we were like, well, I don't have anything, I'm going to kind of stay away from it, sort of thing. But now we have to deal with the new ordinance, right? Any critical things in that? Because there was an issue about the late fees. There were two or three. Any particular things you want to bring forth?
Well, so the thing about this, like you were saying, a lot of people have avoided the city to avoid the Chicago residential tenant ordinance,
right.
Which has been in place since the 80s. A lot
Correct.
of people don't realize how old that is. And we've all found ways to work around it or cover our butts or
Sure.
reduce our liability. But now, just a couple weeks ago in January, they passed the RTLO, which will cover the suburban Cook County.
Right.
Now it's pretty darn close to what Chicago has. Now, thankfully to a lot of people, such as Rogers Park and MBOA and all that, they put a lot of effort to make sure that it wasn't worse than Chicago out of fear that Chicago would come back and modify theirs to reflect
Right.
Cook County. So a lot of it does mirror it, but there's certain, to manage a property in Hoffman Estates, it was just easy. To manage a property in Roselle, Berwyn, you haven't had to follow a lot of these rules. And now come June 1st this year, 2021, everyone's process is going to have to adapt. And certain things like you now have a fixed late fee that you're going to have to charge. So it's $10 for the first, or $5, $10 for the first 1,000, and then 5% for the balance. That's different, and you have to follow that. You have to now tell your tenants exactly where you're going to put that security deposit. If it's going to be in Harris Bank and Roselle, or if it's going to be in Chase and Tinley, you have to have that on your front page. And if you move that account, you have to let them know. Now, one of the things I know a lot of Cook County landlords do is they just use it as cash flow,
Right.
knowing they're going to pay it back.
Right.
But now you specifically have to take that, provide a receipt, and then put it in that specific account with a certain amount of time. Now, there's a lot of there's a lot of these things that, like, how they ever know it took me 72 hours. But some of these things, not doing them by the book will cause you for certain, if a tenant ever does take this to an attorney, which in Chicago, our dealings with the ordinance there is a tenant will take it to an attorney, which they'll get for free. The attorney will just take the lease, go file for a lawsuit against you as the landlord, and then it might be one or a number of different things that you get in trouble for. And then if you're a big landlord, you're always opening yourself up to risk for a class action.
Of course.
So that's always our fear. We want to do everything by the book to make sure that everyone is always protecting the system. So it's those little nuances that everyone's going to have to really adapt to.
No, I'm glad you brought that up because, I mean, fortunately, knock on wood, I only had to face that once, right? I mean, and this was in the suburbs, mind you, but Berwyn, 4 or 5 years ago, we buy a property, auction property. I mean, literally, there were cockroaches, right? And we were fine, the lady living there, but we wanted to clean up the property. So, I mean, I should have known better. I let her put her stuff in the garage. And I'm like, ma'am, we'll clean it up, we'll make it nice. We're going to increase your rent by $100. Okay, great, Andrew. I appreciate it so much. Thank you so much. Guess what? A week later, I get a call from an attorney. So you damaged my tenant's property. I'm like, ma'am, have you seen the condition of the property? We had to bomb that place like 10 different times to get that thing to clean up. We're making it nicer for her. We may gave her some money so that she could go live with her relatives. Oh no, you damaged her property, right? I mean, what do you say? And literally it was blackmail, 100% blackmail, but we ended up paying her $3,000 just to basically get out, right? And I mean, I would have paid her a couple $1,000 to begin with just as a move out, right? But I realized that it's not because I called the attorney. I'm like, man, let's fight. He's like, what for? He's like, the amount of energy you're going to spend, forget about the money part of it. It's just not worth it. And it was completely inadvertent. I hadn't done anything wrong, but it's just one of those things you have to deal with.
And the shame about that is you don't know you have a problem till that legal letter lands up in your lap. And that's so in Chicago, the security deposit piece, the other part that's going to happen, the RTLO that's rolling out this year is you have 30 days to specifically lay out any reasons you're holding that security deposit or holding back any security deposit. And you have 45 days to actually return whatever the balance is. Now, they get that letter for 30 days, before 30 days. It might only be $200 for cleaning the carpet.
Right.
But they just take that letter to an attorney. An attorney's going to blow a bunch of smoke and tell them that don't worry, I'm free and all that stuff, and you don't know anything's wrong.
Right.
So in Chicago, when we first doing, we're like, we'll collect security deposits back in 9. And I found myself returning every single security deposit, 100%, whether it's just or not, because I was so afraid. So, I imagine, for us, we collect security deposit alternatives like surety bonds. And that's going to help us get around some of that risk. But that's the shame is a lot of times with these ordinances, you don't know you have a problem until it's too late.
Right. No, and it's draconian. And a lot of times I think what investors think, and this is where I want most people to think this way. If you're listening to this, watching this, if you're a client of Mark, you have a huge advantage. Because the average person is going to go, oh my God, this is too much of a pain. I'm going to get rid of my property. Right? I mean, God bless. If you manage things correctly, guys, the steeper the hill, the less people are going to climb. The bigger the opportunity for you and I. Yep. Right?
Yep. Like we talked about before.
And I've always believed in that is that, and especially if you're truly going to do this as a business, right? If you're just going to basically, this is going to be kind of one of those things you fool with, probably Chicago is not the place you want to come, right? I mean, stay out of Chicago, there's a million other places in the country. But the returns are good. So let's talk about the numbers, right? The market's been hot. It's been hot here also. But what are you seeing? You kind of touched on a little bit about kind of the REOs. What are you getting a feel for it from your end?
So, the generic term of there's nothing out there, I think that somebody put me in my place a few years ago when I said something like that, and they said, well, it all depends on what you're looking for.
Right.
So depending on what you're looking for, what your financial goals are, there's something out there, and you just have to look for it differently maybe than the next guy that's standing there saying there's no deals out there. But just understanding where those deals are coming from, and whether it be building the relationships with the off-market guys, building relationships with companies like Click Invest or your investment-minded brokers locally. Your group has a whole bunch of resources. So just understanding where those deals are coming from. Now, people always say, the taxes are high, but your prices are pretty low. Yeah. So you really do offset a lot. It's not like you're paying $250 for a single family with taxes $7,000. You're paying $125. So there's a lot of opportunity there still.
It's interesting because the next market we're looking at is Houston, Tampa. Right? Houston taxes are not quite as draconian as ours, but they're higher compared to most part of the country, right? But yet the property prices are higher.
Yes.
So something that all-in cost purchase plus rehab here, I can get in for $120. There, I'm going to have to be 150, 160,
Yes.
right? And you have to adjust for it. Same thing in Florida. If you go to Tampa market, was another market that we looked at, already started buying some of the pockets over there. Same thing, right? You're going to pay either on the price side or you're going to pay on the tax side, right? You're not going to get it both ways. And that's the thing that you have to basically learn is where are those pockets. And the nice thing about Chicago, I have always felt, it's still in the Rust Belt of America, right? And that gives us a strategic advantage, especially if you're a shrewd investor, right? Compared to everybody knows, oh my God, Dallas is hot. Well, no kidding. You and other million other people, everybody is going to go to Dallas, right? And those markets, it's not that you can't find an opportunity, but you have to really, 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 really dig for it. Otherwise, you're going to pay it in the price. Whereas in a market like Chicago, because as big as it is, so we kind of touched on it a little bit. In terms of, do you think there's going to be a wave of REOs or kind of what you had touched on before?
Not yet. I think it's going to be I'm going to kick it out to at least 2022. But minimum, yeah. So I think we're running into this weird time that none of us can control. So you have so everything's been propped up by these trillions of dollars. We still have all these job losses, all these restaurants that aren't fully open, that might not ever fully back open. There's going to be a lot of fallout from all that, and I don't think we've seen that truly happen. Now, what's going to either accelerate or delay that is the government intervention. So
the political aspect.
Yeah,
of
the
things.
political aspect of it. So are they going to start continue with funding tenants to try helping them out, or are they end up just going to get evicted? Are they going to continue helping small businesses keep their doors open, or are those just going to fall? But if they're just trickling a little at a time, leaving enough just for people to hang on, or almost a lifeboat, this could drag out for years, and it'll keep things very stagnant. Now, I think because there's money out there, interest rates are low, and prices are still low, it just gives us a time frame. But all the more important, we have to cultivate our relationships and be able to really drill down on where to find the opportunity.
Right, because what's unique about Chicago specifically is it takes 3 to 5 years to foreclose on a property, right? I don't know of any other place where it takes this long. There may be some places in California, I don't know. But in Chicago, I mean, good luck foreclosing on a property, right? I mean, legitimately, people haven't paid for 3-5 years and they're living in the properties, right? With this whole thing, hopefully they'll use some common sense and not allow abuse, hopefully, after all of this, because at some point, but I think the opportunity is going to get extended. If in Florida, Texas, Atlanta market, you'll see the opportunity much quicker, but it'll be gone much quicker also, right? Here, it's going to be a lingering thing and probably get dragged on for a much longer period of time.
Well, look you know better than I do, a lot of the pricing, and majority short of a handful of gentrifying neighborhoods, has not even reached the 2008 peak that we all saw, versus the entire rest of the country has exceeded that years ago.
Yeah.
So and a lot of that's because it's just what you just said.
Right. No, and I think for a smart investor especially, so having Mark here is appropriate from that perspective, that you really have to build those networks, build those connections and relationships if you really want to pick up properties. So one question I want to ask you before we kind of wrap up, it has nothing to do with today's discussion, but this is something that I'm always fascinated by, especially since you manage so many properties. What's the deal with multifamilies, man? Today, I hear more about multifamilies than I have ever before, right? Everybody and their brother somehow wants to buy multifamily. And I feel it's way too hot. This is just me, in general, as a general statement. That doesn't mean that there are not opportunities. Probably the opportunities, smaller properties, but what's your take on it?
So the multifamily, I think, true opportunity, never really existed, I think.
Okay.
So think about this. When everyone was putting 0% down, I remember I'm coming home from closings, I had money back in 2006.
Right.
I was actually leaving with checks. The people that are buying the multifamily were still bringing 25% to the table.
Correct.
And so, and then, in the housing market that we have around most of Chicago, the suburbs, Skokie, North Side, DuPage County, all those 60s built buildings, a lot of that is generational buildings. So those guys have plenty of money in it. And then when the market crashed in 9, those rents went from $750 to $850 or $950 to $1,050. So they were in a good place. And those never, think about how many 6 flats in the suburbs you actually saw went through foreclosure when the market crashed. Barely any.
Yeah, barely.
Next to nothing. And it was just maybe just a horribly managed or someone passed away type scenario. But So I think that opportunity wasn't there like it was. Now, in the city, you had all these add values and stuff like that, but anything outside of the south side and the C and D class neighborhoods, there hasn't been this awesome, amazing add value or redo things where that's where all this new build and really came into place ground up on the north and northwest side. So I don't think there's as much opportunity there in the sense, but at the same time, whenever I see people get into multifamily, they're usually teaming up with 5 or 10 other people where sometimes their percentage is so diluted that to be solo or with one partner on a portfolio of single families. I've always been a big single family guy.
It's like, you're preaching to the choir,
Yeah.
right? I mean, the other day I had a funny conversation with somebody. This person calls, I'm sure you know the person, and they're like, Andrew, man, I'm up to 50 million. I'm like, dude, it's great. I don't know, the amount of zeros to count over here, but I'm like, well, we're not, right? I'm like, let me ask you a question. What is the net cash flow? What do you mean? I'm like, listen, man, English is my second language, not yours, right? So this is a very simple question I'm asking. Why did you get into real estate, right? If you're investing, I'm like, it's got to be one or two things. From my brain, it's net worth, which is your equity in the building, or cash flow. What else is there? Well, but we control over 50 million properties. I'm like, listen, man, I have one Class A share of Berkshire Hathaway. What am I going to say? I'm worth $3 trillion or whatever Berkshire Hathaway is worth?
Yeah.
I'm like, this is ridiculous. What is the net cash flow on your part of it? Well, I'd rather not bring that up, right? And I'm like, it does a lot of times, the reason I ask that question is because a lot of times it bothers me whenever people try to chase crazy things, which I'm like, guys, even if you get into a multifamily thing, you're going to put up 100, 150, 200 grand, right? To be a part, like a sliver, a sliver of the whole thing. And trust me, you're not the sponsor in the deal. You're going to get barely 5, 8% returns, if that, right? When all is said and done. Because it's just, if everybody today is buying those properties, run to something else, right? The foolish thing is to buy gold whenever gold is sky high, but yet that's where everybody jumps in, right? And that's why I was just kind of curious what your take on it was.
The true opportunity in that is being the sponsor, like you kind of said.
Correct.
And if you really want passive, I think passive on the smaller stuff or out of state that you see a lot on bigger pockets, I think that's tough to do. But if you really want passive, that's in a way when you buy into a fund like that or a syndication, a lot of times you are just a stockholder in that sense.
Right.
And that's,
exactly.
That's truly what that is.
And if you're happy with, it's not that I'm not putting it down, I'm not saying it, but what my point is for a small investor, right, and this has been my belief 100%, right, that single family properties, you literally can start almost with zero. Now, you're going to have to do more work if you don't have capital. I mean, there's no free lunch here. But literally in a matter of 2 or 3 years, you can build up $1 million, $2 million portfolio and have 5,000 to 7,000 net income.
Yes.
Right? And Chicago, to me, is still one of the top markets to do that. Would you agree with that statement?
100%, 100%. And let me add one more thing, because I'm very pro-Chicago in the sense of, we have all of the rail yards and all the train tracks that come through here, and they can't just up and move those, and they're actually putting billions of dollars into upgrading those. And you're seeing all these Amazon, they're investing into all these hubs and all that, which is going to continue to keep jobs here. We do industrial brokerage at our company, and we've never seen occupancy so high. So the bullish concept for Chicago is there, and it's not going away anytime soon. I don't care what any of the headlines say.
No, a lot of times people get confused by the headlines, right? But you have to kind of dig a little bit deeper because, yes, is there an exodus to southern states? Yes. Did Corona kind of speed it up by 10 years? 100%. But guys, listen, Chicago is not going anywhere, period. It hasn't for the last 100 years. It's been one of the top markets for real estate, and it will continue to be. The bread and butter houses have always made money, and if they're bought right, you will make money with it. But the big piece is management. And then you see also a lot of those numbers get jaded because it's the offices or businesses or people moving to the suburbs or vice versa. Correct. And I think that will go back and forth for as long as there's cities and suburbs. Somebody the other day, they're like, well, what do you think about downtown? It's all done. I'm like, listen, man, things happen. right? Look at history,
Yes.
right? We're supposed to end of civilization. It was supposed to happen 100 times over, right? It's ebbs and flows,
Yes.
right? I mean, just before Corona, you couldn't get a hotter time to move to Chicago. Everybody wants to be there. It's the cool part of town, right? And the definition of cool hasn't changed,
Yes.
right? The only thing that has happened is, for at least right now, people are not buying 10,000 square foot houses like they were pre-2006,
Yes.
right?
Yep.
That's the only thing that's changed. Ben, Mark, this has been great. So I want you to bring up your podcast again, because I think that's something that people should listen to. Go subscribe to it. So what exactly is it called? Because I messed up your name.
Straight Up Chicago Investor. So you can find it at straightupchicagoinvestor.com, or we have it on iTunes or anywhere you're going to download podcasts. On our site, we have a bunch of resources. We have our, we have a legal corner that we have a bunch of free legal advice from actual attorneys. We have a house hacking calculator, and then we have a bunch of investor stories. So maybe I get one from you or whatnot, but we have investor stories on there. It's really written stories of people that messed up and how other people can learn from it. So if you ever have those, reach out. We'll put you on. We'll feature you on the website. So
Great. So guys, I hope you guys enjoyed today's podcast. This was kind of really good because Mark is somebody, if you especially are interested in Chicago, this is the guy to go to. And there's very few people that I tend to be rather fanatical in my beliefs, but this is somebody that truly can add immense value, and he cares about the business. That's rare to see in the real estate business, so he does care about the business. Having said that, hope you guys enjoyed. Again, the website is 257cashflow.com. Again, that's 257cashflow.com. Subscribe, share with your friends, and talk to you guys soon. Thanks much.